Hello friends, I am CMA Deepansh and today let's get right into it and understand the real impact of the RBI repo rate on your loans and your EMIs.
So let me ask you something. Have you ever looked at your bank statement and just been shocked? Your home loan EMI has suddenly jumped up, but wait, you haven't taken out a new loan. How does that even happen? Or maybe you've gotten that classic text from your bank, right? The one that says, your interest rate has been revised. Well, the reason behind all of this, it's something called the RBI repo rate. And today, I'm going to show you how this one single rate is quietly pulling the strings on a huge part of your financial life. All right, so let's really dive in. In this explainer, we are going to break down what the RBI repo rate actually is, and, way more importantly, how it directly hits your loan EMIs, your interest rates, and yeah, even your savings. Seriously, trust me on this. After this, you'll be tracking the repo rate just like you track cricket scores. Okay, first things first, what on earth is this thing called the repo rate? Well, the easiest way to wrap your head around it is to think of it as the absolute foundation for the interest rate on your loan. So what's the official definition? It's actually pretty simple. The repo rate is just the interest rate at which the Reserve Bank of India, the central bank of our country, lends money to all the commercial banks. We're talking about SBI, HDFC, ICICI, you name it. And this is where it gets really clear. Think of it like a chain reaction, right? Step 1, the RBI lends money to the banks. Step 2, the banks take that exact money and they lend it out to people like you and me for home loans, car loans, all that stuff. And here's the kicker. Step 3, whenever the RBI changes its lending rate, that change is absolutely going to trickle down and affect the rate you pay. It's a direct connection. Okay, so now that we know how it works, let's look at the first scenario. What happens when the RBI decides to increase the repo rate? What's the direct impact on your wallet?
Well, the very first domino to fall is this. Borrowing becomes more expensive for the banks themselves. Suddenly, their cost of getting money from the RBI just went up. So when a bank's own costs go up, what do you think they're going to do? They're not just going to absorb it, right? Nope. They pass that extra cost right on to you, the customer. And the result for you is one of two things. Either your monthly EMI goes up or, and this is a tricky one, sometimes the bank keeps the EMI the same but just makes your loan tenure longer. That means you end up paying for many, many more years than you planned.
And to show you just how real this is, think about this. If your home loan interest rate goes from, say, 8% to 9%, that's just a 1% jump. Your EMI can literally increase by thousands of rupees every single month. This is exactly why, during times of high inflation, when the RBI is raising rates, so many people really start to feel that financial squeeze.
But hey, it's not all doom and gloom. Let's flip the coin and look at the other side. What happens when the rate decreases? Because this is where some fantastic opportunities pop up for borrowers. So in this scenario, the RBI cuts the repo rate. And just like that, borrowing suddenly becomes a whole lot cheaper for the commercial banks. You see, their main cost, the cost of getting funds, has just gone down. And you guessed it, they pass that benefit right along to you. The banks will start to reduce your loan's interest rate. So what does that mean? It means your monthly EMI goes down, putting more cash back in your pocket each month. Or, hey, if you decide to keep paying the same old EMI, your loan just gets paid off much, much faster. Win-win. So, here's the key takeaway here. If you're thinking about a big purchase, this is the time to pay attention. An environment where the repo rate is falling is often the absolute best time to take out new loans, whether it's for that dream home, a new car, or maybe even funding your business. But you might be wondering, why does the RBI keep changing these rates anyway? Is it just random? No, not at all. Let's take a quick look at the bigger economic picture to see exactly what they're trying to do. You see, the RBI is constantly doing this really tricky balancing act. On one side, their main job is to control inflation, right? To keep the prices of everything we buy from shooting through the roof. So if inflation is high, what do? They increase the repo rate. That makes borrowing more expensive, which slows down spending and helps cool down the hot economy. But on the other side, if the economy is slow and sluggish, they can't just keep rates high, so they do the opposite. They decrease the repo rate. This makes borrowing cheaper, and it encourages all of us to borrow and spend more, which gives the economy a much-needed boost. It's this constant push and pull between fighting inflation and stimulating growth. So as you can see, the repo rate isn't just some number that affects your loan. It is a powerful, precise tool that the central bank uses to manage the entire country's spending habits, influence how much we borrow, and basically steer our overall economic growth. Okay, so we know the RBI uses this tool to guide the whole economy, but who really feels these changes the most? It's really important to understand the risk that comes with your specific type of loan.
All right, so who gets hit the hardest? Without a doubt, the group that is most impacted is home loan borrowers. Why? Well, because the loan amounts are just so huge and the repayment periods are incredibly long. But the most crucial factor here is the type of interest rate you have. If you have a floating interest rate loan, and that means your rate can literally flow up or down with the market, you are going to feel the impact almost immediately. And of course, businesses that rely on loans and credit to operate are also heavily affected.
But wait, what about fixed-rate loans? Well, if you have one of those, you're in a pretty good spot when rates are going up. Your interest rate is locked in for the entire loan period, which means, for the most part, you're safe from all these frequent changes.
So here's the main thing I want you to take away from all this. The next time you're scrolling through the news and you see a headline that says something like, RBI has increased the repo rate, please don't just skip past it thinking it's some boring financial jargon. Because as we've seen today, it directly affects your EMI, it affects your savings, and it affects your entire financial plan for the future. And this really just sums it all up. One tiny little rate change by the RBI can end up impacting your finances by lakhs of rupees over the lifetime of your loan.
Hey, if you found this explanation useful and to clear things up for you, please do me a quick favor. Hit that like button, share it with your friends or family who could use this info, and of course, subscribe for more simple finance explanations just like this one. Thanks so much for watching.